Welcome to Himalayan Stocks Gurukul, where we guide you towards long-term investment success with market stability.
Global equity markets are currently breaking under the weight of a sudden liquidity shock, a rebellion inside the Federal Reserve, and a brutal tech crash that is sending shockwaves directly into Indian portfolios. Markets had priced in a dovish pivot, but the Federal Reserve just held rates at multi-year highs in a highly unusual 9-3 vote. Dissenters Hammock, Logan, and Neil Kashkari actively rebelled against the pause, demanding an immediate 25 basis point hike to combat persistent inflation. At the same time, Chair Warsh drew a hard line, categorically refusing to accept any implicit inflation target above the strict 2% mandate. With the Fed now deeply split over that 2% target, the market is bracing for a timeline measured in years rather than weeks, forcing a rapid repricing across every major asset class. The spark for this panic comes straight from the Middle East. With supply chains through the Hormuz Strait heavily disrupted, energy prices have spiked 24%. For a central bank terrified of inflation, volatile crude oil is the exact worst-case scenario, because high energy costs immediately bleed into the price of every other good and service. The reaction on Wall Street was instantaneous. Early market rallies completely evaporated as the Dow plunged over 1,100 points. Tech took the heaviest collateral damage. The Nasdaq officially entered correction territory as soaring borrowing costs compressed the valuations of major AI and semiconductor stocks. A localized policy split in Washington, fueled by a physical supply shock overseas, instantly ignited a widespread liquidation event across global equities. Tracking the U.S. 10-year Treasury yield, we see a vertical spike crossing the 4.67% threshold, pushing past 5.2%. Bond markets are independently tightening financial conditions. Adding a second line for Indian bond yields, this expanding gap between the two is the yield spread. As that spread widens, foreign portfolio investors, or FPIs, start losing money automatically because the Indian rupee depreciates against the newly high-yielding US dollar. To stop those currency translation losses, these institutional funds are mathematically forced to sell off their Indian stock holdings and move that cash back into safe haven US Treasuries. Global liquidity is currently being vacuumed back to America, exerting direct pressure on Indian equities, regardless of their underlying domestic earnings. The sheer volume of this foreign capital leaving the country is crushing the Indian rupee. To see how the central bank manages this, look at this flow visualization. The Reserve Bank of India sells its US dollars to buy and support the rupee, but doing so actively drains rupee liquidity out of the domestic banking system. With less cash floating in the system, commercial banks have to pay much higher rates to secure funding. This directly squeezes their net interest margins, the core profit they make between borrowing and lending. Those higher bank costs immediately trickle down. Auto loans and mortgages get expensive, dampening real estate and car sales, while downstream IT firms watch their US clients freeze discretionary spending. Defending the rupee requires the RBI to drain domestic liquidity, creating a secondary pressure point that raises borrowing costs and slows demand across the broader economy. With liquidity drying up, the strategy of automatically buying every market dip is suspended. The focus now shifts strictly to defense. Pharmaceutical companies offer massive structural protection here. Because they export drugs globally, a weaker rupee actually translates to higher corporate earnings when those foreign revenues are brought back home. Upstream oil explorers act as a secondary bunker. They pull crude out of the ground, meaning they directly profit from the higher realization per barrel caused by the Middle East shock. But the ultimate safe haven remains physical capital. Gold has rallied past $4,100 an ounce as investors seek absolute shelter from the currency volatility. Surviving this environment requires actively moving capital away from rate-sensitive domestic stocks and rotating it into export-heavy defenses and hard assets. To navigate the immediate fallout, look at this technical price chart of the Nifty 50 index. It maps exactly where institutional buyers are staging their defenses. The first critical support is the 50-day exponential moving average at 24,100. If the price breaks below this line, it triggers automatic sell orders and mass unwinding from retail traders. Below that lies the institutional trench at 23,750. This represents a previous point of heavy consolidation, making it a psychological zone that large funds will defend fiercely. The absolute final stand is the 200-day simple moving average at 23,300. A daily close below this red line legally shifts the entire market structure from a temporary pullback into a structural bear trend. Macro events explain the exact reasons why capital leaves the system, but respecting these strict mathematical levels dictates whether your portfolio survives the exit.